All right, let's dive into a real economic puzzle because right now, the signals we're getting from the US economy, they're not just mixed, they are telling two completely different, totally contradictory stories at the exact same time. So on one side of the coin, you've got the amount of stuff being shipped around the country, and it's falling. Pretty hard, actually. That usually screams slowdown, maybe even a recession. But then you flip the coin over, and factories are getting a flood of new orders for big, expensive things, which points to major growth. It feels like the economy has one foot on the brake and the other slamming on the accelerator. So, how? How is that even possible? That's the mystery we're going to unravel in this explainer. And to do that, we have to start looking for clues. And our investigation begins in a place you might not expect. We're turning to an unlikely detective, the freight industry. You know, the trucks, the trains, the planes, moving everything around, they're so much more than just logistics. They are a fantastic window into what's really happening inside the economy. It's a super simple idea, right? But it's also incredibly powerful. Before you can buy absolutely anything, a new phone, a piece of machinery for a factory, that package at your door, someone, somewhere, had to ship it first. And that's exactly what makes freight what economists call a leading economic indicator. Basically, the shipping data gives us a sneak peek of what's coming down the pipe for manufacturing and retail sales, often weeks, sometimes even months, before the official government numbers come out. It's kind of like getting an early look at the economy's next chapter. Okay, so let's put on our detective hats and follow the evidence. We're going to dig into the key clues hidden inside all this freight data and see if we can figure out what's truly going on. And our first clue, well, it's a big one. And boom, here it is, our first major piece of evidence. The Cass Shipments Index, which is a really trusted benchmark for this stuff, is showing a pretty staggering 7.8% drop compared to last year. That's a huge contraction. It tells us, flat out, that way fewer goods are being moved around. Now, you gotta understand, this isn't just a recent dip or a bad month. If you look at the timeline, after that huge post-pandemic surge in 2021, we have been in a steady multi-year slowdown. The slide started in 2023, it kept going in 2024, and now it's getting even steeper. We're talking about a full-blown structural freight recession. Which, of course, leads to a pretty logical question. I mean, basic supply and demand, right? If demand for shipping is way down, then prices, they should be falling too. But that's not what's happening at all. And this brings us to our second clue, which is, honestly, it's bizarre. Just look at this paradox. Even as the volume of shipments is plummeting by almost 8%, the average cost per shipment, what they call inferred freight rates, is actually up by more than 8%. So fewer things are being shipped, but the average shipment is somehow more expensive. This makes no sense on the surface. So what on earth is going on here? Well, the secret isn't some crazy price inflation. The answer is something called a modal mix shift. Think of it this way. We're shipping less stuff overall, sure, but the type of stuff we are shipping has changed. We're moving away from shipping tons of smaller, lighter boxes of consumer goods, and we're shifting toward fewer, but much bigger, heavier industrial shipments. When you move to that bulkier freight, it pushes the average cost of a single shipment way up, even if the actual price per mile hasn't really changed much. This modal mix shift is the key. And this next piece of data, this is the smoking gun. This is the clue that breaks the entire case wide open and shows us those two different economies we're living in. This slide right here tells the whole story. Just look at that divide. On one side, you have rail intermodal traffic. Now, that's mostly the stuff that carries finished consumer goods from the ports to cities, and it's down almost 6.5%. But then you look at the other side, rail carloads of metallic ores and metals. You know, the raw materials for heavy industry, for factories. They're UP 5.5%. One part of the economy is shrinking, while the other is actually growing. So what does it all mean? Well, the freight data has given us a crystal clear diagnosis. We're not in a simple boom, and we're not in a simple recession. We are living in a two-speed, or what's called a bifurcated economy. And here's the formal definition. A bifurcated economy is just one where different parts are moving in opposite directions at the very same time. The economy that deals with consumers and retail is slowing down, while the economy that deals with industry and manufacturing is holding strong or even growing. And that's exactly why all the headlines are so confusing. So what's causing this massive split? Well, there are really three big forces at work. First, you have retailers. They completely overordered during all that supply chain chaos, and now they're desperately trying to sell off mountains of excess inventory before they even think about ordering new stuff. Second, spending on big industrial projects and infrastructure is still really strong. And finally, you have policy shifts, things like tariffs, that are forcing companies to totally rethink their global supply chains. And that affects the consumer side and the industrial side very, very differently. Okay, so where do we go from here? That's the big picture of what's happening now. Let's take a look at the forecast for how this might all shake out in 2026. The path back to a balanced market, interestingly, probably won't come from a sudden boom in people buying stuff. Instead, it's more of a painful but necessary correction on the supply side. See, this long period of low demand and high costs is forcing a lot of the smaller trucking companies to go out of business. As they leave the market, that oversupply of trucks starts to shrink, capacity gets tighter, and then, finally, shipping rates can start to level out and recover. And hey, if you're wondering how much you should trust that forecast, and who isn't skeptical of forecasts these days, just take a look at this. The analysts at ACT Research, who work on this CAS report, have an absolutely incredible track record. Their 2024 predictions for trucking rates, they were 98.8% accurate on average. That's not just good, that's an almost unheard of level of precision. It definitely gives their outlook a lot of weight. Okay, so we've been talking a lot of high-level economics. But what does a two-speed economy actually mean for you? For your wallet, for your job, or for your business? Let's bring it home. So, if you're a consumer, the good news is that the strength in the industrial sector probably lowers the risk of a really deep, widespread recession. The bad news? Don't expect huge sales on everything just yet. Now, if you're on a retail business, you're in a tough spot. You're getting squeezed by falling sales on one side and high costs on the other. But if you're in an industrial sector, things look a whole lot brighter, with continued strength and maybe even job growth. And for investors, this is a huge reminder that you have to look under the hood of the overall market, because the averages can hide some serious weakness and some serious strength. And all of this brings us to our final, big question. We've figured out what's happening right now. But is this two-speed economy just a temporary, weird adjustment as we sort things out after the pandemic? Or are we actually looking at a new, more fragmented economic normal? The answer to that is going to shape our economy for years to come.